Hello, welcome to Handout 9. Handout 9 is going to focus on inflation, Treasury securities, and Treasury markets. And this is going to correspond, of course, to homework number 9. So, as always, one thing that I'd like you to remember is that it's going to be much less torturesome for you to play back this video at an increased speed. So the way to do that is once you have the video playing, go down to the bottom, the little gear icon. So click on the little gear icon and you'll see playback speed up here. Click where it says normal and you'll have options like 1.25, 1.5. Probably 1.5 is going to work best. And of course, as you know, you can pause the video, move back and forth however much you want. Okay, with that in our pocket, let's get started. I know some of you have had information on inflation in prior courses. Particularly those of you who have had macro econ. So if you're comfortable with inflation, you should feel free to skip ahead on this information. And for everyone else, let's get started here. So first of all, what do we mean by inflation? Okay, inflation is just the rate at which overall prices in the economy are rising. So it's going to be a weighted average of home prices, gasoline car prices, food prices, phone prices, things like that. There are a couple of measures of inflation in the US. There's the GDP price deflator, for example, but the most common measure of inflation and the only one that we're going to use in this class is what's called the Consumer Price Index, and that's known everywhere in economics and finance as the CPI. And the CPI has a great qualitative meaning. The CPI literally is the cost of a specific basket of goods or services that are purchased in the US. So that's really nice when we see CPI numbers, which we conveniently see on the next page here. What these actually represent is the cost of this basket of goods and services, in this case at the end of year 2007, in this case here at the end of year 2006, etc. And obviously, what's in the basket changes over time, right? In the 1960s, 1970s, there were no smartphones. Clearly, smartphones are in the basket now. So that's one of the problems with the CPI is how do you change what's in the basket over time? But nonetheless, it's considered a pretty good measure of inflation. So this is measured by the U.S. federal government. Data is available. This data is available all over the place. So I've just taken a string of years of CPI data at random. And what we want to get from this CPI data is we want to get what's called an inflation rate. And we're going to do all of this in annual terms. So what we want to do is from the cost in, say, 2007 versus 2006, we want to measure how much the inflation rate has increased in that time or occurred in that time. And here's how we do it. Okay, the inflation rate over a period of time, we're going to measure in percent, okay? It's going to be the CPI at the end of the period we're concerned about, minus the CPI at the beginning of the period, whole quantity divided by CPI at beginning of period. And through the magic of algebra, you can see here we could simplify this to CPI end of period over CPI beginning of period minus 1. So let's do this for 2007. So for 2007, end of period, we would have 207.34. And then we'd want to take end of year 2006, which is 201.6, and take that whole quantity and divide it by 201.6, and that's equal to 2.8%. And of course, you should check me on that 2.8%, but I think you will agree. Okay, so what else would be good to do here? We don't have to measure inflation just 1 year at a time. So we could measure it, for example, from end of year 2000 to end of year 2007. So let's go ahead and do that. So I'm ending up end of year 2007. So once again, I want to take that 207.34, and now I want to go to end of year 2000, which is 172.2 here. So I'll take that 172.2 and divide that by 172.2, and that's about 20%. And again, check me on that. Count on having this type of calculation on homework and also on exam 2. So verbally, how do we describe this? For our 2000 to 2007 example, we could say something like this, that inflation increased prices by 20% from end of year 2000 to end of year 2007. Okay, so here's a nice graph of inflation rates over time, and you can see that over time, so this is 1920, going to 2010, you can see inflation has spiked very high at certain times, 20% here. That's prices increasing 20% in a year. That's big deal. And also we have negative inflation, which is called deflation, which means that prices are dropping here. And since the 1980s, roughly, inflation has been what economists call very contained, rarely going above 5% and never dropping below 0. And so now we're going to use our understanding of inflation to develop real and nominal rates and returns, okay? So let's remember, for a financial project, we've been looking at that R, that's our compound interest rate, and we're going to define that a little bit differently. Actually, I take it back. We're not going to define it a little bit differently. We're going to describe it a little bit differently here. We're going to, in this chapter, call this our nominal interest rate, R, okay? And what do we mean by that? All we mean is this is the actual rate of interest paid by borrowers and received by lenders. This is exactly what we have been using so far, okay? So the R, the compound interest rate, the discount rate that we've been using up till now, putting in our time value equations, that's what economists call the nominal interest rate, okay? And we need to now develop a couple more things here. The real interest rate, we're going to always write as R sub R, R with a little subscript R, and that's defined to be the rate of interest paid and received above the rate of inflation. And we need one more formal quantity to really get the show on the road here. And let's define the inflation rate mathematically. And we're always going to describe that as R sub INF, standing for R inflation. And that's just the annual rate of inflation as found on previous page, right? Okay, and then one other thing that investors talk about sometimes is the real return on an investment, and that's just the return on an investment project after backing out the effect of inflation. The key thing you want from this page, though, is to memorize these three definitions. So nominal interest rate is just what we've been using all the time. Real interest rate is our rate of interest above the rate of inflation, and inflation rate, our inf, is just what we computed from the CPI on the previous page. Okay, so we've got some relationships between our nominal interest rate and our real rate and inflation. And the most important one, which you can use whenever the inflation rate is below about 6%, which we've seen from the 1980s till now. That's always been the truth, nothing but the truth, right? So in cases like that, so let's say use this unless otherwise instructed. Okay, because why? Because it's been the way to go since the 1980s. We have a really simple relationship here. It says the real rate, the real interest rate of a project is equal to our compound annual interest rate, or our nominal rate, as we've been calling it here, minus the inflation rate. So this is nice and qualitatively makes sense, and it's very simple, and it's the one that we're going to use. I have a little squiggle here, a tilde symbol, which means sort of kind of equal to. It's not perfect. The reason that I have to do that is because there is a more perfect relationship among these three quantities that looks like this. As you can see, this is nonlinear. It's sort of a mess. And happily, we don't have to use it unless inflation is really high. Okay, so with low inflation, if you use this, you get the same answer as this, but more significant figures, so whatever. So we're going to use this guy. All right. Just good to know that there is a more accurate relationship among these three that we would need to use if we had hyperinflation in this country. So what are some important features of these three quantities? Well, first of all, what do investors want? Investors always want the compound annual interest rate of their investment to be greater than inflation, right? Or their nominal rate to be greater than inflation. So that implies, of course, that their real rate has to be greater than 0, right? Because the RR, I can't do the subscript here, so you've just got to bear with me, is similar to R minus R inflation. Okay. So you want that clearly to be greater than 0. If your real rate is greater than 0, you're doing better than inflation, and that is a good thing, okay? So if your real rate is less than 0, the meaning of that is that your investment isn't keeping up with inflation. And an important way to think about that is that the cash you would get coming out of your investment when your investment is over, or you're getting some cash out of it, it's going to be able to buy less stuff than it could have bought when you started the investment. So that's never good. It's good to think about real rate being less than zero in both of these ways, not keeping up with inflation, and the amount of stuff you could buy when you take money out of the investment at the end is less than what you could have bought at the time when you put money in. So let's do an example. So let's go to back in time to 2007. Blah Bank is offering a 1-year 2% CD. Inflation is running at 2.8% at this time. Two questions. What's the real interest rate on Blah Bank CD, and what is the deeper meaning of that? So first of all, let's do A. That's pretty straightforward here. Actually, let me just check. I think I might have this on the next page. Yeah, we'll do A here and B on the next page. Okay. So we've got the real rate is RR, right? And that's equal to our R nominal, or our annual compound interest rate, just like we've been using all the time, minus R inflation. Okay, and and I'm using equal here now because this is the equation we're going to be using. Okay, so we've got the rate that Blah Bank is giving us, the nominal rate or the annual compound rate, is 2%. Okay, and we have to subtract from that 2.8%, which is equal to minus 0.8%. Okay, so the real rate is less than 0, all right? So let's go to the next page here. And so for A, I'll say see prior page. Okay, so this means that Blah Bank CD is what? It's not keeping up with inflation. That's for sure. And our second way to think about it, remember we have these two important ways to think about this. $100 invested in Blah Bank CD today will purchase less stuff in a year. Okay, it'll be able to purchase less stuff in a year because it's not keeping up with inflation. Okay, another thing might be good for you to know is how economists talk about this a little bit more. They'll also say something like the purchasing power of an investment in Blah Bank CD would decline by 8% over a year. That's sort of common sense. They'll also say something like investment in Blah Bank CD will be worth less in real terms in a year. Okay, but these are the two key points for us up here in red. Okay, so with that in our back pocket, we can start looking at Treasury securities and why they're so important and how they're used in finance. Okay, so let's do an overview on this. Okay, the U.S. Treasury Department issues Treasury securities. These are debt securities, okay, and they're put into two big buckets. If they're short term, in other words, the contract is going to end in less than a year, they're going to mature in less than a year, they're called notes, okay? And if they're longer term, that's defined to be a year or greater, out to right now 30 years, they're called bonds. Okay, so notes are just, as far as Treasury is concerned, short-term bonds. Contracts are exactly the same, just have a shorter maturity. Collectively, the notes and the bonds are called Treasuries. So when people are talking about Treasuries, that's what they're talking about. They're talking about Treasury debt, either notes or bonds. Okay, so why would the Treasury issue these securities? Well, it needs cash, right? Just like any other borrower, right? It's doing this to get cash, okay? And why does it need cash? It needs cash because the federal government's expenditures are greater than tax revenue. Okay, so this is a problem. This is a constant problem um, in governments, federal, state, and local, primarily federal. And when this happens, we say that the Treasuries issued these bonds because it needs to fill the deficit hole. The deficit is the expenditures of the government in a given year minus the taxes. Okay, so that's what the deficit is about. That's why the Treasury has to issue bonds or notes. Okay, so let's just put the Treasury market in context a little bit. There's 11 billion in outstanding, 11 trillion rather, in outstanding Treasury debt. I have no idea what that means. That's way too big a number. So how can I put this into terms I can understand? Well, how about the worldwide global bond market is 80 trillion? So it's about an eighth of the size of the total worldwide bond market. So that's pretty big, right? Another way to think about it, which is very helpful, is that it represents 60% of the annual US GDP. So that means if we wanted to pay down all of our Treasury debt, in 1 year, we'd have to take 60% of GDP and devote that all to paying down that debt. Okay, so just by the by, if they wanted to do the same thing in Japan, they would have to take 1.8 years worth of entire GDP to pay down their sovereign debt in Japan. That's bad, especially because their demographics are bad. Their population is shrinking. Okay, but that's a story for another day, probably another class. How else can we think about the Treasury market? There in 2018, about 1.1 trillion bonds and notes were issued, and that was, of course, about the size of the federal deficit. So federal expenditures were $1.1 trillion more than tax revenue that came in 2018. That's probably not so good. Okay, and another way we can think about this is to look at trading volumes. And for the treasuries, about 800 billion trades per day. And if we look at the entire US stock market, it's only about a tenth of that. Okay, so there's a lot of trading in treasuries. And treasuries you can trade 24/7, 365 days a year. So for all these reasons, the Treasury market is considered the most liquid and transparent market essentially in the world. That's going to be important as we go on. All right, so what are our characteristics of Treasury securities? This is review because we've covered this. This is at least the fourth time we've covered this now, right? These are all essentially bonds, right? So they're going to be happening in a contractual framework, okay? And what it means for the Treasury, for example, is they issue a bond, they're going to get 100 million now, they're going to pay rent on that of, say, for example, 10 million every year for 3 years. This is a very simplified example, of course, and then they're going to pay back that 100 million at the end of 3 years. And as we know, like all bond contracts, treasury bonds, and notes, okay, are transferable contracts, so they can be bought and sold after issuance in secondary markets, and the price that they're bought and sold at after issuance in secondary markets has nothing to do with the contract, right? The Treasury has to pay whoever is holding the bond per the initial contract terms, just like any other bond we've talked about since the first day of class, in fact. Okay, so second important characteristic of treasuries is their risk. So treasuries are considered by everyone in finance and economics as virtually risk-free. And I have that in quotes. Why do I have that in quotes? Because what people mean by risk-free when they're talking about risk-free treasuries is they mean there's virtually no probability that the US Treasury Department will default, okay? That the US government is not going to be able to cough up the cash needed to repay those bonds and notes. So other ways to think about this are investors are definitely, almost definitely going to be paid back in full and on time. And this implies that investors buy treasuries when they're worried about the failure of other investments, like right now, sitting here March 11th in 2020, when folks are very worried about the economic impact of the coronavirus, and the brilliant move by the Saudis and the Russians to get into a fight, leading the Saudis to flood the world oil market with oil at a time when the global economy is moving into recession and demand is very low already. So when this happens, when bad things are happening macroeconomically, folks around the world put a lot of their money into treasuries because they're considered so safe. And that's called, when that happens, a flight to quality or flight to treasuries. And that happens very strongly in market panics. Okay, and for all these reasons, this helps the US dollar, which of course is closely tied to treasuries, be considered the world's primary reserve currencies. If you're freaked out about what's happening, and you are in, for example, Malaysia, you want to buy US treasuries, so what do you have to do? You have to buy dollars, because treasuries are only sold in dollars. Okay, so this all does not mean that treasuries are riskless. It does mean the risk of the US Treasury Department flaming out is very low, okay? But it does not mean there are no risks with buying treasuries. So let's look at what some of the risks are of buying treasury bonds or notes. There's one class of risks that is shared with any investment in the whole wide world, and that's called duration risk. Duration risk is simply the risk that we're going to have a bad outcome, and that risk, of course, increases with the length of the project, because the farther we're looking into the future, the harder it is to say with certainty nothing bad is going to happen. And so here's my favorite illustration of that. This is a graph put together by the federal government right around the beginning of 2009. We're coming out of the Great Recession. And these were predictions of GDP going forward. So the dark blue line here is their expected value prediction, and all of the lighter lines around it represent one standard deviation above or below their predictions. And what you can see here is the farther you go out into the future, the less certain the US government was of its estimates for GDP. And this is true for any investment. The farther you go into the future, the less certain you are, the more risky that investment becomes. Okay, that's true of treasuries, that's true of any project, any investment in finance. Okay, so that's risk for any investment. So the second big bucket of risks for treasuries are treasury specific. And these are threefold: inflation risk, interest rate risk, and that default risk that we already talked about, the chance that the Treasury Department won't repay you. Okay, and so all of these risks, duration risk, which was in A, and these three in B, they're not independent. Okay, clearly inflation risk is going to be tied to interest rate risk, and all of these risk, duration, inflation, interest rate, are going to be tied to the probability of the US government defaulting on its treasuries. Okay, so with all this in mind, we're going to call, with everyone else in finance and economics, we'll say, okay, yeah, whatever, we'll agree with you. We'll call treasuries risk-free securities, but we will remember, as everyone else does in finance and economics, that there are these risks, okay, these four risks: duration, inflation, interest rate, and default, okay? And we'll also say that our treasury interest rates or discount rates are going to be called risk-free rates, and we're going to write them in equations as R sub risk-free or RRF. So that's how we'll be treating these going forward. So let's do an example illustrating treasury bond risk. Very simple, straightforward example. So let's say, excuse me, you're considering buying a 10-year zero coupon treasury bond at issuance, given a few things. The face value, remember the face value is what is going to be paid back at maturity. That's 100. So we have $100 face value, par value, principal value bonds here. The inflation rate today is 2%. And remember, we write that in equations as R sub INF. And right now, investors are sort of medium scared of riskier stock investments. Remember, the more scared they are of stock investments, the more they're going to put money into treasuries. And today, investors are demanding a risk-free interest rate for this bond of 8%. Okay, so how did they get to that 8%? Treasury bonds are sold at auction. And so what'll happen is the biggest 20th bank, the biggest 20 banks in the world are allowed into these auctions, and someone like JP Morgan Chase will say, well, I'd be willing to buy this 10-year bond with an interest rate of 9%, and Wells Fargo is going to say, well, I'd be willing to buy it for just 8%. So Wells Fargo wins that option, and the rate would be set at 8%. So what is that 8% comprised of? This is comprised by, so in the auction sale, Wells Fargo won. It said 8%. Where does that 8% come from? Well, clearly 2% inflation is part of that. And Wells Fargo says, I want an additional 6% over that for other stuff. What's that other stuff? That additional 6% accounts for everything but inflation, interest rate risk, default risk, and duration risk. So that's where that total 8% comes from. 2% from inflation, okay, and the other 6% from the rest of the Treasury risk, right? So these are the remaining Treasury risks. Okay, so with this in mind, we can, using everything that we have learned in time value of money, we can figure out the price paid for each bond, right? So what can we do? We can use that fundamental present value, future value formula. The present value is going to be the price paid, and that's equal to the future value divided by 1 plus r raised to the, what do we have? 10 years here. I believe it's a 10-year bond. Yep, okay. And that's equal to, so the face value is what we get back. That's the future value. Okay, and this is 1 plus 10% raised to the 10. Okay, and if you work that out, again, you should check me, but when I work that out, I get 46.3. Right, always, always, always check these. Do this before you try the homework, anything like that. It'll make doing the homework much quicker. It'll make your exam studying much better, and it will make you get a higher score on the exam. Okay, so make sure you understand how I did that, and it all should make sense to you. By the way, these were very important. Forgot to mention up here before, oh no, these are zero coupon bonds. So zero coupon bonds are just of this form, right, where you pay something for the bond today, and you don't get anything, you don't get anything, you don't get anything, and then in the future you get that. So this is a zero coupon bond. It's just a 2 cash flow bond. Zero coupon bond. All right, let's move on. So now we're thinking about the risk of treasuries, okay? So we were on the board of Wells Fargo. We approved this 8%. We won the treasury auction, so we got this. And what happens if the next day we need some cash at Wells Fargo? So we decide to sell this bond. And let's consider 2 scenarios. In case 1, inflation expectations overnight have risen to 6%. Nothing else has changed. This type of inflation shock definitely has happened. It definitely will happen again in the future. Classic example of this is in the 1970s when OPEC overnight raised the price of oil by about 50%, and that led everyone to change their inflation expectations because oil is such a big component in the CPI. So that has happened in the past. It will happen again, and it can happen overnight, just like this. Okay, so if nothing else has changed, so investors did demand so today nothing else has changed except inflation has shot from 2% to 6%. Okay, so now they're going to demand an RRF of what? Of 6%, okay, for inflation plus 6% other equals 12%. Okay, so that's just right on the overnight that's changed. So now we sell the bond. So what's the price going to be paid? It's going to be 100, that future value, divided by 1 plus 12%, okay, raised to the 10. And let me just copy that over into Excel. And that's 32.2, okay? So overnight, we paid for this bond 46.3, so we're going to lose 46.3 minus 32.2, and that's not good. That's equal to, can I do this one in my head? Yes, I can, 14.1 per bond. Not so good. So this is a very realistic scenario. You buy a bond, you have to sell it soon, inflation expectations have changed. That's moved the price of the bond, and you come up a big loser. Okay, so definitely you want to understand this for homework and for exam 2. Okay, so here's another case. So we bought that bond yesterday at 46.3. So overnight, world peace is declared. Okay, awesome. So what's going to happen if world peace is declared? Anybody going to want to invest in these paltry treasury bonds that don't pay very much? No, right? We're going to go if there's not much risk in the world, what's going to happen? People are going to move their investments from treasuries to stocks. So if they do that, what's going to happen to demand for treasuries? It's going to go down. What's going to happen? We know from economics, if demand goes down, the price is going to go down. So you could again lose $14 per bond. So if things go very bad in the world, or if things go very well in the world, you could lose a lot of money on this. So treasuries, the takeaway purchasing treasuries is not a risk-free project. Okay. Okay, now let's look at what's called the Treasury yield curve. Um, and let's start this out by reminding ourselves, in general, all of our projects have duration risk, right? That's the risk that says the longer the project, the riskier it gets. Okay, so what this means for treasury bonds is the longer time we have till maturity, the increased possibility we're going to have of something bad happening, like we saw, and inflation expectations could change. There could be a big change in interest rates. There could be a big change in investors' views of the treasury defaulting, and that would cause problems for our investment too. So if we get these problems, that means, of course, we have an increased probability of losing money. And that might be specifically because, as in the case we saw before, we need to sell the next day for whatever reason. Wells Fargo needed to raise money, and the bond could not keep up with inflation if inflation expectations jumped a lot. And bond restructuring, that means really default. So what happens in a default for a country, and this happened with Greece recently. I think there's another country right now, I can't remember which one it is, who just decided it was probably going to have to default. Basically, the country goes to all its investors and says, hey, we're not going to be able to pay all these back. So you restructure the bonds, reducing the interest rate and pushing the duration of the contract way into the future. So it does really involve a default. Okay, so what does this mean? Because we have all these risks that happen as our duration increases, we should expect that investors demand higher yields for longer dated treasuries, right? That's just common sense. And if we look in the marketplace, that is found out to be true empirically. And we can see that in what's called the term structure of Treasury interest rates, and a graphic representation of the term structure is called the Treasury yield curve. And that's what we're going to focus on. So let me show you what I mean by that. So here we've got a couple of Treasury yield curves. How do these work? On the x-axis, we have time, okay? And on the y-axis, we have YTM. Remember, YTM we just learned is EAIR in bondland. EAIR is the same thing as YTM for a bond, right? It's the compound annual interest that we're going to get on this. So I've got two curves here from time 1 and time 2. And really what I want to show you here is how these were constructed. The way they were constructed is I went out to Bloomberg and I found what was the YTM for a 1-year treasury bond, and I plotted that. And then I went out to Bloomberg and I found what was the YTM or the EAIR for a 2-year bond. And these are all zero coupon bonds. And I went out and I did the same thing for a 3-year bond, and then a 5-year bond, and then a 10-year bond, and then finally up here a 30-year bond. And then literally all I did was draw a line between these points that I had plotted. And that's your yield curve. So what does this yield curve show? It shows that if I'm an investor, the marketplace says the market yield for a 1-year treasury is just over 2%. But if I want to go out for 2 years, more time for bad things to happen, more duration risk. So I should expect a higher interest rate. And in fact, that's true. I can get a higher interest rate. I can get almost 4% for a 2-year treasury. If I want to invest in a longer treasury, more duration risk, more time for things to go bad. So I should get a higher interest rate. I do. I get about 5%, and et cetera, et cetera, et cetera. So this is really just a graphic representation of duration risk for treasury bonds. So let's see how I've described this here. So we have an increasing interest rate for treasuries with increasing time to maturity, increased RRF, EAIR, YTM, with increasing time to maturity for the treasuries, okay? And the other thing I'd like you to note here is that the curve does change in time. Again, I've done this for 2 times. Here's time T1, and here is time T2 in these 2 different colors. And the reason the curve changes in time is because people's risks, view on the riskiness of the world and treasuries changes over time. Sometimes people feel more worried about near term than long term, so that's going to bring the near term part of this curve up here and not so much change the long term part of the curve. So we might get something like that and still ending up here with these guys, and things like that happen. So it's a live curve. It does change over time. Okay, so those are all the key basics of treasuries. So let's review them, because we're going to be using treasuries in a lot of models for the rest of the semester. So what are the key characteristics we've looked at? They're universally considered to be the safest investments in the world. Okay. It's not always true, but it's good approximation. Their risks are relatively few and well understood. What are those risks? Duration, and you need to know these risks. You just gotta memorize the risks of treasuries. So there's 4 risks for treasuries: duration, and if I could type, I could get us the other 3. Inflation, rates, interest rates. Okay, and we've got the default. And default is very small. So they're well known, relatively well understood. Second key point is treasury market, one of the biggest, most liquid, transparent markets in the whole wide world. Okay, and for these reasons, treasuries are gonna be a foundational part of most of our risk models going forward. So what are our beautiful risk models going to include here? Okay, so I've got here a summary of risks we're going to have to think about for our investments going forward. Another way to say that is what's going to be included in our risk models. Okay, so far what have we looked at? We've looked at duration risk. That's going to be featured in any financial project that we do. And what's it include? It's just the increased probability of bad stuff happening the longer out into the future we're looking. And the other thing we've looked at here in this chapter are the risk-free risks with treasuries, which are, we've got duration already, so I need three more. So we've got inflation, interest rate, okay, and default, right? Okay, don't forget duration for treasuries, right? Because duration is for anything. So that gives us a total of four for treasuries. Okay, so these are the ones that we covered in this chapter. Okay, and what's coming up in the next chapter are going to be these risks. Industry or market risks, that's going to be for anything that's not a treasury, and a project-specific risk is going to be for all non-diversified projects. Okay, so these are, let's make those double stars. Okay, so that's going to be coming up in the next chapter. Let's make these both double stars here. Okay, and that does it for handout 9. So I'm going to sign out now and look forward to seeing you all again soon for handout 10.